This intensive session examines economics and CFA Level 1 exam. Economics accounts for 10% of the CFA Level 1 exam. In other words, the exam will have 24 questions from this topic. In previous exams, it will be 12 questions in the morning session and 12 questions in the afternoon session. This year, CFA Institute has made significant changes in the economics session of the curriculum. We will discuss the changes in detail later in this training. This training will first cover the common topics examined in previous CFA Level 1 exam. We will provide a detailed analysis of the questions appeared in previous CFA exams and corresponding concepts examined. Then we will discuss the changes in the curriculum in the June 2012 examination. In macroeconomics, aggregate demand and aggregate supply analysis is the common topic tested in CFA Level 1 exam. To study monetary policy, LM framework is used and is commonly tested. Fiscal policies, for example, government tax policy, is another topic that has been consistently appeared in CFA Level 1 exam. Monetary policies and its impact to interest rates are another consistent topic in CFA Level 1 exam. Roughly 1/5 of the questions in economics are from this topic. Unemployment and business cycles account for roughly 2 to 3 questions in CFA Level 1 exam. CFA Institute has been consistently designed questions on unemployment and business cycle. For example, Phillips curve is one major topic examined under this topic. Other minor topics appeared randomly in CFA Level 1 examination. For example, game theory and Nash equilibrium are some common minor topics appeared in previous exams. These minor topics usually account for approximately 10% of the questions in this session. In terms of exam taking strategy, candidates should have a glance of these minor topics as CFA Level 1 exam will focus on definitions or facts in these topics. The likelihood of asking in-depth questions from these topics are relatively light. Changes in CFA curriculum economics. CFA Institute has adopted major changes in economics of the CFA Level 1 curriculum. It has added more coverage on the consumer choice theory, but reduced the coverage on factors of production. Another important change is the introduction of international finance. In terms of microeconomics, additional material for financial reporting with consumer choice theory and utility theory, indifference curves, opportunity sets, and budget constraints. According to Learning Objective Statement 20 of the CFA 2012 curriculum, candidates are expected to describe consumer choice theory and utility theory. Candidates are also expected to describe the use of indifference curves, opportunity sets, and budget constraints in decision-making, calculate and interpret a budget constraint, determine a consumer's equilibrium bundle of goods based on utility analysis, compare substitution and income effects, distinguish between normal goods and inferior goods, and explain Giffen goods and Veblen goods in this context. These topics are new in this curriculum and thus, it is very likely to have questions in the coming June exam. Candidates should pay specific attention on these topics in the learning objective statements. For example, technical analysis was added in June 2011 exam in quantitative methods and there was several questions from that topic. In terms of importance, it is quite important for candidates to be familiar with this topic. Some other new topics include the following. Candidates should be able to calculate and interpret total, average, and marginal revenue, describe the firm's factors of production, calculate and interpret total, average, marginal, fixed, and variable costs, describe break-even and shutdown points of production, explain how economies of scale and diseconomies of scale affect costs, describe approaches to determining the profit-maximizing level of output. In terms of macroeconomics, the most significant change in this part is the introduction of international finance. Candidates are expected to define direct and indirect foreign exchange quotations and convert direct, indirect, foreign exchange quotations into indirect, direct, foreign exchange quotations, calculate and interpret the percentage change in a currency relative to another currency, calculate and interpret currency cross rates, convert forward quotations expressed on a points basis or in percentage terms into an outright forward quotation, calculate and interpret a forward discount or premium, calculate and interpret the forward rate consistent with the spot rate and the interest rate in each currency, describe exchange rate regimes, explain the impact of exchange rates on countries' international trade and capital flows.